Hello, everybody. Welcome to the Enlightened Investor, your home for economic and financial education and insight. We're glad you're here. I know there's a lot going on in the world today, a lot of geopolitical events. Actually, this is the day after the Russian invasion of Ukraine, and our hearts and prayers go out to all the people of Ukraine. Tough times for them, and if you have any friends or family over there, just know that we're thinking about you. Um, today's episode is about war and conflict, and what does it mean for our economy, and what does it mean for investments, the market, and your plan. So, what all investors should know about when there's war and conflict, and we're going to take our good Benjamin Franklin here and start off with two enlightened quotes. The first quote is from Ben himself. He said, "There never was a good war or a bad peace." And, where did that quote come from? It came from experience that he had on the frontier in the French and Indian War. Back in 1756, Benjamin Franklin led a group of about 170 men to kind of go out and protect the English colonies and the frontiers people from the Shawnee as well as the French. And they actually ended up setting up a fort out there. And he saw for real the devastation that war brings, burying his friends and his men, so he knows the hardships that war brings. So definitely, there's never been a bad peace. Thank you, Ben Franklin, for that quote. Also, Ayn Rand here. If men want to oppose war, it is statism that they must oppose. And what is statism? It's where the state has a substantial influence on the society as well as the economy. And you can kind of think about that where like the individual is minimized. Remember, Miss Rand, she always talked about how freedom and capitalism is kind of is very important. It was kind of where her heart was. But she also brought up some really important points. She wrote a book in 1966 called The Roots of War. A great book. I recommend it. And in there, she kind of lays out how statism and communism, socialism, authoritarianism, anything essentially it's not democracy and capitalism, these lead to a lot of conflict and liberty reduction. So if you don't observe individual liberties, how can you observe country liberties, right? And one of the things she said in there in 1966, which I think is still true today, is that there has never been two nations that have gone to war that were free and capitalist. So if one of the things I can leave you with is on her is that she said we need to promote capitalism and free tradeism to enhance peace. So we thank Mrs. Rand for those enlightened quotes. So today's outline is really going to be about two things. What's the impact of war on our economy? And what's the impact of war on investments? Let's go ahead and take a look at that, as well as some investor takeaways. So let's take a look at the impact of war on our economy. And there's really two opposing views. Imagine that, right? Economists having two opposing views. And this is going to get down to, once again, the Keynesian viewpoint versus sort of the classical, neoclassical viewpoint. So the Keynesian viewpoint, as you know, this is the group, the Keynesians from John Maynard Keynes, the incredible economist that he was. He always talked about how demand creates supply. Right? And if you spend anything, you'll have a multiplier effect to that, right? You'll create jobs. And this is true with like digging a ditch or making our new road out here in Peoria, Illinois, right? Or it's true with regards to war and conflict, right? So if you spend some money on military expenditures, on armaments and weapon systems, that is spending, period. And it stimulates demand, it stimulates jobs and GDP. And let me give you a quote by Paul Krugman, sort of like the today's version of like what you would say a neo-Keynesian. You'd say, what saves the economy and the New Deal, this is back in the 1930s, was the enormous public works known as World War II, which finally provided a fiscal stimulus adequate to the economy's needs. So again, it wasn't the New Deal that saved us. It wasn't anything else. It was actually this humongous effort to re-energize the resources of the country toward a common aspect of, in this particular case, it was war and conflict in Europe and Japan. So that's one view, is that like, hey, it's going to shift out aggregate demand and the economy is going to expand. The other viewpoint is sort of the classical viewpoint, where really it's about supply, and production creates prosperity, right? It's not destruction that creates prosperity. It's all about what can you do to enhance productivity and production. So one way to look at this is through the eyes of Frederick Bastat and his broken window fallacy. And I've got a picture of him here on the screen. And Frederick Bastat, he said, this was back in early 1800s. There was a story, he said, of a boy with a little ball, and he threw the ball and it went into and broke the baker's glass and the glass window. And so initially, if you take maybe the Keynesian approach, you'd say like, hey, this broken glass needs to be fixed. It's going to stimulate demand and job for the window maker, and so it must enhance the society. But the thing is, a good economist and a good financier will say it's what is not seen that you need to take into account. And what's not seen is that the baker whose shop window was broken was going to go buy a pair of shoes from the cobbler down the street. And so society, if you just break the window, has a fixed window, right? But if the window was never broken, the society would have a perfectly good window and a pair of new shoes. And so the classicals and Frederick Bastat would say war raises debt and thus the tax burden on the society. And kind of following up on that viewpoint is our only model. I promise, folks, this is the only model I'm going to throw at you. It's going to be really easy. This is the Adam Smith specialization model. This model was actually created by myself and Dr. Hendrik Vandenberg. He was at the University of Nebraska, Lincoln at the time. And it's just a very simple model. And we're just looking at per capita real GDP on the vertical axis. And that's really, if you want to think about that as income per person. And on the horizontal axis, we're going to take a look at time. Okay? And so Adam Smith was looking at why did countries grow and prosper, and why did other countries just suck? And he wanted to know, like, how do you make growth happen? All right? And how do you make growth happen? As he said, you need to specialize. Make the economy specialize, make people specialize. And so this is like a model of that specialization process. So let's say we take a look at point zero. The country starts at point zero and starts moving through time at a particular growth path and the slope of that angle there. And it runs into time t=1, where a conflict begins. And this conflict, think about this as Ukraine, or it could be Russia at this point, that this war has a general negative impact on society. Why? Because it reduces specialization. It reduces trade. It reduces physical capital. It reduces labor force. And war reduces interstate connectivity. And so this interstate connectivity between people and nations is what drives specialization and productivity in the population. And so you're going to have a sharp decline. I mean, Ryan knows that the stock market of Russia went down by 33% yesterday when they attacked. Folks, that is the fifth largest decline in the history of stock markets in one day. And that's because of war and conflict, right? And what happens is you have an instant shock down, and then notice that the growth path between T1 and T=2 is flatter. And that's because there's less specialization taking place. Then maybe a positive event takes place, such as, you can think about this as peace is declared. There's an introduction of stable currency, or common currency. In the United States, that happened in 1913. We had a common currency, right? This is a positive interstate connectivity enhancement where people can specialize more, right? If you have increased property rights, if you have increased foreign direct investment, maybe better roads and transportation, all these things matter to help enhance productivity in a country. And that will create a jump at time t=2. And then the country's growth path grows at a faster, steeper slope. So that's a really kind of easy, I hope you guys like that. It's easy to follow that specialization model. Well, maybe some of you are turned in because you want to know what's going to happen to the financial system when you have a war. And so how does interstate conflict impact markets? And we have to take a look at, like, why do markets generally do well or generally do poorly? And I came up with like 5 things. This is not just me coming up with these things, but this is kind of like common knowledge, is that markets like slow to moderate economic growth, right? They like stable prices. The markets like low levels of uncertainty and a growing Federal Reserve balance sheet. There's a direct and significant correlation. You can test it out. It's a significantly t-tested that when the Federal Reserve's balance sheet goes up, so does the markets, the SP market. And there's a reason for that. There's liquidity enhancements, all kinds of stuff. And the last one is strong earnings growth. So of those 5, which one of these 5 does war negatively affect? It affects number 2 and number 3, and I put those in red here. That that war will affect stable prices. Notice that this is going to be like an aggregate supply shock. Today, as we look at sort of Ukraine and the Russian country, there are a lot of commodities and resources there. They're a big exporter of oil and aluminum and nickel and cobalt. And what is the price of oil today? Over $100 a barrel. What's the price of aluminum? It's actually at an all-time record high. What's the price of nickel? It's a decade high levels. So this is a negative supply shock for the world, for the countries involved in the war, and including ourselves. And that's why the stock market, has been selling. One of the reasons has been selling off. And how about number 3, uncertainty? Well, war definitely raises the risks and uncertainty. And, the thing with war is, I'll tell you, like Abraham Lincoln said it best, it's like, he says, it's easier to get in than to get out. And so we do not know where this war is going to take us. It creates a lot of extra uncertainty. And so just kind of think about that. Why is the market selling off, Dr. Luer? It's selling off because there's a lot of uncertainty in the marketplace right now. Okay, so let's go to the next slide here on the buildup of uncertainty, anticipation for invasion. I think we all know that there was, the markets were sort of, as Russian troops moved into Ukraine's space, into Belarus and on the border, that there was a sell-off. Uncertainty built and built and built, and sometimes that has sort of a decline. And there's been some, in the past, what happens is sometimes, not always, but when there is an attack, there's actually a little bit of a positive movement in the markets because the anticipation is finally over, right? Like there is actually an invasion. Now that doesn't mean that the markets are going to go up in the midterm, because you can see, like during the Afghanistan war, the markets did improve right after the invasion, but then it fell off again. So those are some things just to kind of look at, is that, man, uncertainty does play a role in market performance. Okay, the geopolitical events and the stock market reaction. I thought this was a good idea, is like, what should we expect as investors if Russia invades Ukraine? What should we expect from this conflict? Well, you know what? We don't know. Every time is different. But what we can maybe do is get a little bit of an understanding of maybe an average of past conflicts. So if you take a look at this slide, we have 7 different conflicts. We've got the Russia-Ukraine, the U.S. terrorist attack on 9/11, Iraq invades Kuwait in 1990, the Yom Kippur War in 1973, the Cuban Missile Crisis in 1962, the Korean War starts in 1950, and then, of course, the Day of Horror, Pearl Harbor attack in 1941. So I've tried to cover every decade here except the 80s and then the 2010s. And so what you have, if you look over in the third column there, you see the S&P 500 index, what happened on the day of that event. And strangely, when Russia invaded Ukraine, yesterday was a really wild day. A huge decline in the morning, and then it shot up again. We were up by 1.5%. Today is kind of a mixed day. If you go down and look at the average at the bottom, that usually on the day of the attack, we're down about negative 1.9%. how does the S&P 500 do over like the total drawdown? Like, in how long, what's the lowest it goes from this attack? And you can see that on average that it goes down about 5.7% from this conflict. And how long does it take to recover before we get to right where we were before the attack? And the answer is about 3.5 months, 105 days. So, yeah, war and conflict generates a lot of uncertainty, and markets do have a little correction, but it takes about 3.5 months to recover on the ones that I selected. So the next question is like, how should investors respond to war when we see these things? Should we panic sell? Well, absolutely not, right? So I've got 5 things to look at here. Number 1 is in the short term, markets have historically responded negatively to news of interstate conflict, which we saw on the last screen. Number 2, patience is rewarded. This is the thing that Mike and Ryan here at Cypress Asset Management, they talk about this all the time, is that your patience will be rewarded. And I've got a slide on that about the Wilshire 5000 coming up. And stocks will produce for you a healthy return in the long run, because really it's just a reflection of the economy and the productivity that's taking place within the system. Number 3, hang in there. I'm scared too. I had a meeting yesterday with my dean, and she didn't like it either. I said, "Oh, it was the morning time. The market's down. It's correcting." She's like, "Oh, don't tell me that." I don't think she was going to panic or anything, but some people do. I mean, I remember, folks, here at Bradley University, I had friends that when the markets corrected from the financial crisis, the volatility occurred, that people just got out, and they never got to recover from. They sold at the low and they never bought back. It's so sad. Number 4 is uncertainty is a part of life, is it not? Remember that those hodl slides we talked about? Like, it's hard to hold on for dear life. But remember that you probably employed a good financial advisor, and they developed a plan with you that takes into account the uncertainties of life. So hang in there. And the last thing is, if you feel bad, just zoom out in history. Get some perspective. The time in the market is the key to success, financial success, right? So just stay in the market. It's going to be, it's in the long run, it's going to work for you. So, taking those into consideration, what did Warren Buffett say? He said, the stock market is a device for transferring money from the inpatient to the patient. Hang in there, right? And so Mike just sent me this morning, and he said, look at this great slide here. Like, not only does, it only takes 105 days or roughly for the markets to kind of get back to where they were, but look at the next 12 months. Like the 1970s oil embargo, if you can just hang on from that negative 42% decline, the next 10 months or 12 months gets you a 38.1% positive return, right? Black Monday, right? In 1987, I remember that day. People were jumping off of skyscrapers in New York City. It was terrible. But that year was up for the year. Remember that? The tech bubble, the financial crisis, COVID sell-off. I mean, we've had incredible gains in the markets in the last 2 years, even though all the tragedy and the issues around that whole pandemic. The last slide I'll leave you with, so thanks for hanging in there, folks. And this is the one about stay patient and staying in the market. Patience is rewarded. Take a look at this. This is the total stock market index. It's the Wilshire 5000. If you had invested $1 in 1970, and where would it be today, right? Where would it be today? And it would be over 200x increase. So, I don't know. I have young children at home. I've got a couple of teenagers, and they're starting to work. And I tell them, I say, hey, listen, if we can set you up in a Roth IRA, we're going to be able to 100x your initial investment in the next 40 or 50 years. I mean, look at the Wilshire 5000's done. Stephanie, your investment can do something similar. It's no guarantee on it, but we can probably get a good 100x over a 40 or 50 year horizon. So anyway, there's ups and downs in there. It's not fun to go up those ups and downs, but man, what a payoff you can get. So folks, I hope you enjoyed today's content. I mean, a war is a terrible thing. It doesn't feel good going through them. There's a lot of uncertainty in the market, a lot of volatility. I think the thing that we want you to come away with here is we want you to stick with your plan, continue to read, and continue to reach out to us with any questions you might have. So thanks a lot for showing up today. This is the Light Investor, signing off.